Welcome back again to my YouTube channel. So in today's video, we're going to be talking about the concept of what liquidity. So if you master the concept of liquidity, you'll be able to drastically improve your win rate. Okay, you increase your risk to reward ratio, and then you'll be able to bank consistent profit in the market. Know that consistency is equals to what? Consistent result. So in this video, we're going to be focused mainly on what is liquidity, how to identify liquidity, and then how to spot institutional trading zones, how to identify liquidity and inducement, and how to trade high probability trading setups, okay, and how to avoid liquidity traps, and then how to enter and exit the market. And if you are interested in this subject, please leave a like button, subscribe, so that I'll be encouraged to do more and more videos like this. All right. Without wasting much of your time, let's dive into it. Okay, so for this particular strategy, we focus mainly on three time frames: the 4 hours time frame, which is the high time frame; the 1 hour, the 30 minutes time frame, which is our intermediate time frame; and then the 15 minutes time frame, which is our medium time frame for entries. So the first thing you want to do, you want to be identifying the structure of the market, okay, which is the 4 hours. From the 4 hours time frame, okay, you identify the structure of the market. Is it a bullish market? Is it the market in a trending phase? If you're able to spot stuff like this, that means the market is in a trending phase. Okay, 30 minutes time frame is for intermediate buyers. Okay, is the market in a correction phase? Okay, if the market is in a correction phase, you want it to come to your area of interest before you can actually take your buys to the upside. And then the 15 minutes time frame is for confirmation. You want to get confirmations from the lower time frame and then get your candles and then enter. Now let's talk about liquidity. When we talk about liquidity, what's the first thing that comes to your mind? So liquidity can simply be defined as the rate at which there is supply and demand in the market, okay, or the ease at which one can actually buy and sell in the market. Okay, so now when we're looking at liquidity, okay, your strong highs, okay, your strong lows, are all liquidity. Okay, for the strong highs, there is what? Buy side liquidity. For the strong lows, we have the sell side liquidity. Also, for the equal highs, we have the buy side liquidity. And then the strong low, we have the sell side liquidity. And then your trend lines, all those are what liquidity pulls forward for the big banks to actually manipulate the trade. Okay, for the big banks to manipulate, because for basic market structure traders, they want to actually be selling at the high here. Okay, all this you want to be selling here. Okay, because that's a double top. Okay, and you want to be buying here, which is a double bottom. All those are what instrument for the big banks to actually use this method and what manipulates the market. Okay, we'll come to that. That leads us to inducement. So at this area you want to be buying, okay, and then going all the way up. At this area you want to be selling, going all the way down. So what do the institutions do? They manipulate it. Okay, we'll look at that. That gives us what? Inducement. So, and then your trend lines. So because you want to be selling, you were taught to actually sell here. When it touches the trend line, you sell. When it touches the trend line, you sell. When it touches the trend line, you buy to the upside. So what happens? The big institutions are going to use that to actually manipulate you and then take out your stop loss and then push the market to the upside. So therefore, we'll be looking at the advanced market structure. That will help you to be able to trade like the big institutions and stop looking at the market with a layman perspective. All right. So now let's look at inducement. What is inducement? When we talk about inducement, what is the thing that comes into your mind when we talk about inducement? Okay. So refers to certain levels in the market that encourage participant to trade at those levels because they believe those levels are actually highly reliable. Okay. So at the end of the day, what happens? You see a double top pattern. Okay. You see a double top pattern. What happens? You see a double top pattern. Okay. What happens? Market ends up going higher and then coming all the way down to the downside. All right. So you end up being manipulated. You end up being manipulated. Okay. The stop loss ends up being taken out. Okay. Your stop loss ends up being taken out, and what happens? The market tends up to sell in your direction. So that's for double top. And then for double bottom, okay, same thing happens. All right. What happens? The market pushes down a bit, and then what happens? It goes your direction. Why? You have been induced. Okay, you have actually been induced to provide liquidity. You understand? You have been used to provide liquidity so that the big players can actually fill in their orders. All right. You have been used to provide liquidity so that the big players can actually fill in their orders. So this video will help you to stop being the liquidity. You understand? All right. So now the double top, the double bottom, all the chart patterns are actually used to provide liquidity. And then now triple tops, all those chart patterns are used to provide liquidity. So you stop looking at the market like that. You'll be able to have a wider perspective of the market. And now let's look at the break and retest patterns. All right, let's look at the break and retest. So what ends up happening? You see that the market will actually push lower and then push up. You get what happens? You have been used to provide liquidity. Sometimes the market will come, take out this low and then push to the upside. Why? Because you have been used to provide liquidity. You wanted to buy somewhere here. All right. You wanted to buy because we have been taught about break and retest. You want to enter here. What happens? The market comes a bit lower, takes the low, and then push to the upside. So that is inducement. You understand? That is what we refer to as inducement. You get. So now let's look at the sweep zones. Okay, how do we trade using liquidity? We don't want to. We are tired of being taken out. We are tired of being stopped out. So how do we use liquidity to take trades to our advantage? Okay. No. So now what I want you to do now is to be able to spot liquidity in the market. So let's say let's say this right here is you're actually expecting a double top pattern. All right. So what happens? There's liquidity is provided. Okay. The market takes out liquidity. All right. So there is a break of structure here. The market takes out liquidity, provides break of structure to the downside. So what you want to be doing to be able to trade like the institution traders is you want the market to actually take out the liquidity. All right, come to that zone, give you a confirmation, then you sell to the downside. This is the one way which I use. I spot the liquidity and then trade the liquidity. You understand? So you spot the liquidity and then you trade like the institutions. All right. So you don't want to be getting yourself stopped out. You don't want to be getting yourself stopped out. You don't want to be getting trapped. You understand? You don't want to be losing trade consistently. So what happened? You spot that, you wait for that, and then you get your entries, and then you sell to the downside. Okay. So this is one way which I use, but this is not strong. Okay. This is A++. Okay. This is the strongest setup of all. So this one is strong. Okay. This one is strong. This one is better. And then this is the strongest. This is the highest probable setup. Okay. So I'm just going to take my time and just try to explain it all for you guys to understand. Okay. Just listen and understand. So what happens? There's a sweep of liquidity, there's a break of structure, you wait for the market to get back to your area, then you sell it all the way to the downside. So here what happens? There's a sweep of liquidity, and then there's a sweep of liquidity. Then there's an internal structure which provides what structural liquidity. Okay, here what happens? The market created what structural liquidity. So since the market created structural liquidity, that means the market will always come back and then grab that liquidity. Okay, so you want to be what riding with what the liquidity. So the market comes, tap into your what? Your POI. Your POI is what? Your point of what? Interest. So the market comes, tap into your POI, and then you look for a confirmation within that area, that point of that POI. Your POI is your what? Your point of interest. Okay, taps into your POI, then you sell. All right. So you don't want to be the liquidity. All right. So you don't want to be the liquidity. You want to participate with the institutional traders using this particular method. So we have the sweep of liquidity. We have an internal high-low structure. Okay. Then that means there's a break of structure here, and then there is a break of structure here. All right. Let's provide us with our break of structure. Sorry. Okay. So this provides us with what our break of what structure. All right. So what do you want to do after the break of structure? You want the market to actually come back to what? Your POI. Okay. So what happens? It comes to your POI. You look for what? Your confirmation. And then you sell all the way to a downside. Okay. So you sell all the way to the downside. You can decide to keep your stop loss high above there. All right. But if you are using confirmation like myself, okay, I use confirmation from the 15 minutes. All right. And then my target is always here, the first target, and then the second target, and so on. So, but this is the most probable setup of them all. Let's look at it now. All right. Let's look at this setup. This is the most probable setup of them all. So what happens here? This particular setup, we have what? Two break of structure. So this makes it what? Highly what? Probable. Okay. So we have our sweep of liquidity. That sweep of liquidity gives us what? A protected what? High. Our sweep of liquidity gives us what? A protected high. All right. So that becomes what? A protected high. And then we have our what? Our first break of structure, which is this. All right. So mainly some traders will be, okay, this is breakout, and then they'll begin to look for the retest level, okay, and then expecting the market to keep going to the downside. But the end of getting was stopped out, okay, because what? They have not actually tuned their mind to be able to trade like the big institutions. Okay, so what I'm giving to you now, I'm giving to you guys this particular method to actually what? Learn to what? Spot liquidity in the market. Okay, like trading above, like here, some traders want to be selling here. Okay, so what happens? They'll end up getting what? Induced. Okay, they'll sell and then the market takes them out. Okay, some want to sell here. Okay, why? Because they're looking at break and retest. But that is what your structural liquidity. This is what your structural liquidity. You want to be selling. You want the market. Structural liquidity is what? To provide what? Inducement. Okay, so that the market will come and then sweep it out. All right. So we have our second break of structure. We have our second break of structure. What happens? What do you expect? You expect the market to actually come back, scrap that liquidity, tap into your POI, and then sell to the downside. Okay, grabs the liquidity, tap into your POI, and then sell to the downside. So right now, what are we going to do next? We are going to look at what we have looked at, how to actually trade that. Okay, so to trade it, you wait for the market to actually come to that area, and then you take your sells in the smaller time frame, and then you exit here. All right. So now let's look at some live examples, fam. Let's look at some live examples. All right. So now let's look at some live examples. So as you can clearly see, this is the GBP USD chart. So looking at this here, all right, you can clearly see that there's what? A sweep of liquidity, and then there's a break of structure to the downside. Okay, so already that should actually tell you that, okay, we have what? A trend to the downside. Okay, so that means that should tell you that we have a trend to the downside. So you go to your intermediate time frame, like the 30 minutes, the 1 hour. Let's use the 1 hour for instance here. Okay, let's look for sell opportunities. All right, let's look for sell opportunities. You see right here. Okay, so right here we can clearly see that there's what a sweep of what liquidity. All right, so let me zoom in a bit on that. Even if you don't want to use that, okay, and you feel it's not clear, you can clearly use this one. But here we have a sweep of liquidity. Okay, we have a sweep of liquidity there. All right, so we have a sweep of liquidity there. Okay, even if you want to use this area here, it's still allowed. Okay, so you have a sweep of liquidity, you have your structural liquidity still there. All right, but let me just keep it here for clarity's sake. We have our sweep of liquidity. All right, the market made it high, swept that area to the upside. Okay, I'm just trying to perfect it. So we have a sweep of liquidity, we have our protected high. Okay, we have our structural liquidity. So here what happens? All right, you can go to the smaller time frame. What I advise you to learn to do is go to the smaller time frame. Here's your POI. Okay, so you go to the smaller time frame, you look for confirmation. You can go to the 5 minutes time frame, the 15 minutes time frame, you get confirmations, and then you can clearly sell. If you get a clean confirmation on the 5 minutes time frame, you can sell, and then your stop loss just slightly. That increases what your risk to reward ratio, like I said. So, but you know that if you keep it here, your risk to reward ratio becomes smaller. All right, so you see, easy targets, easy PC, guys. So here again, like you can clearly see, this setup is actually really clean. Okay, so we have a sweep of liquidity. All right, we have a sweep of what liquidity. All right, you already know that the market's to the downside, and then we have a break of structure here. We have a break of structure. Okay, we have a break of structure, and then we have a pullback, which is more than 50% of your Fibonacci 2. Okay, we have a pullback which is more than 50% of your Fibonacci 2. All right, so what happens? That pullback becomes what your structural what liquidity that will be swept later to serve as what inducement, and then you have your second break of structure. Okay, second what break of structure. What happened? You enter here. All right, even looking at this on the 1 hour, I can actually enter when that's a hourly candle close and then pull back. Okay, here we have our protected high. Okay, and then here we have our POI. POI stands for our point of what interest. Okay, clearly stating that's the area where you want to actually be entering your trades from. Okay, so you see what happened. The market gets to your point of interest, you take your sells. Okay, take your sells, see your target always here, right? Your first target always there. So you see 1:8, and then you can target the other ones. All right, so that's how simple the strategy is. And please, if you love to trade the way I do, please hit the like button, subscribe to this YouTube channel. So now let's look at another example again. Okay, so here already what happens? You look for your sweep of liquidity, which is this. Okay, that is checked. You look for a break of structure to the upside. We have this break of structure. Okay, so do we have a pullback? Yes, we do have a pullback. Is it up to 50%? Yes, we have, which is checked. We have this becomes what your structural liquidity. Okay, I'm just going to zoom in a bit so that you see it and follow. Okay, we have a sweep of liquidity, we have a break of structure to the upside. Okay, all right, we have our break of structure. Okay, so we have our break of structure. So we have a pullback, this pullback here, this one here. All right, we could go to the smaller time frame. Okay, but that will cost us a lot of time. So it's at the 50%. That's provide structural liquidity. Here we have our structural liquidity, and then we have our protected low. Okay, what happens? See, we have our second break of structure. Okay, we have our second break of what structure, and then the market traded back into a POI. Okay, the market traded back into our POI, you can see. So like I said, you enter upon confirmation on the smaller time frame. Okay, so your stop loss just slightly below. All right, your first target should be here. That should be your first target, and then your second target, just like that. So you have smashed a what? A quick 1:5, and then 1:9 respectively. So that is actually simple. Okay, so you have been able to see how to actually use liquidity in your favor. Okay, so hit the like button, subscribe to this YouTube channel for more and more wonderful videos like this.